I'm looking at some of the other questions that come in. They're very similar comments here, but they're related to naked puts from 2. So Ben was the next question. It's related to this. And Ben says, I'm trading covered calls in my IRA. How can I use a covered call to protect against loss? Well, let's take Ally Financial, Ben. So let's say that 8 to 10 days ago, 12 days ago maybe, I'm using this because this is a married put I'm in that's doing what it does, and I'm happy with doing what it does. It's been working out well for me. Not as great timing as I'd like to have. But in any case, let's look at Ally. Currently at 5106. About 5 days ago, we were up to about 54, almost 55. So that was the 8th. I'm sorry. Now, it was the 28th or the 27th, if I remember correctly. How do I know that? It's because this is when I sold my 55 call. In the next 4 days, the stock dropped. It's now at about for September expiration, but it's about at a 45, almost 50% profit from when I sold the position 4 days ago. Okay, but let's go back to the 28th. And we're going to use the quotes page here. We're just going to go back in time. August 28th. Mike? 27th, I believe. Let's see where we were. 53, 54. Let's go to the 29th. That's when, 30th, I'm sorry, that's when it started to fall. Okay. So 53, 54. That's about where it was. So, Ben, let's take a look at the historical chain a little bit. And let's see what the 55 strike calls were, as well as, now it doesn't offer a lot of strikes there, so it's the 55 and the 52.5. We'll take a look at both perhaps. But let's go to the chain and see what those call premiums were for Ally Financial back on the 30th. We were at 27th, we were at 53.54. September, the 55, 76 cents. Let's just go to the call chain. All right, that's better. 76 cents, that 1.4% premium, 1.5 premium I'm looking for, percent if assigned of 4%. Pretty reasonable. The 50, just about a 1% premium there with 7.5, midpoint of 403. So our 50 is at 403, and our 55 is at 76. Okay, now, let's go ahead and just look at the position real quick. With the stock at 53.54, in this case, we'd gauge, Ben, that the at-the-money option with the highest time value was likely that 55 strike for September with a 76-cent midpoint premium. As you can see, it's already down to 8-9 cents from where we entered it. Okay, so why am I going through all this? Well, it's to illustrate a point. We bought the stock at 53.54. It's now down to 51.06. We're down $1.50. I'm sorry, $2.50 on the stock. You originally sold a call for 76 cents. That's a hedge of 76 cents. But if the stock starts to move in the wrong direction, Ben, in this case, then what ends up happening is you always typically lose more on the stock than you're gaining on the call option. Now, can I roll this position down? Meaning, I chose it as a covered call first, and the stock started to decline. I can make close to, well, a little bit more than that, almost the 70%, 80% I usually look for to close a position in this case, by buying to close the call for only about 10 cents. It's about 65%. But I could buy to close it for 10 cents and roll down to the 50. I'm going to collect probably $1.40 for September, $1.50 to help hedge the $2.50 I've lost. But is it going to hedge all of it? No. When the stock starts to move down quickly, you're losing more on the option. I'm sorry, you're losing more on the stock, Ben, than you're losing on the covered call. What is my hedge here? You said your question was, how can I use a covered call to protect against loss? Well, you protected against 76 cents in this case. Let me add it to the portfolio. We're going to create a new portfolio here for protecting with covered calls. We're just going to put this in, and yeah, we'll go ahead and change the date to the 27th, just for aesthetics. All right. So now I'm in my portfolio and I get a great overview. My original expected gain and loss for both legs was that 4.2% bend we just saw on the profit and loss chart. My current loss is $182. I've lost $248 on the stock and gained 66 on the call, or 86.8%. And if I hold it to expiration, I get another 0.1% time value decay, so I'd still be at a loss of 3.3%, with Ally staying right around 5106, below the 55 strike call. Now, can I repair this? Possibly. As I'm tracking a covered call, naked put, or any other position, we'll go to Position Actions and then Position Analysis. The Position Analysis gives me a breakdown of where we currently stand on our position. We know our liquidation loss and our future expiration loss if the stock stays at the same price. We just saw that. But down below, we see some potential rollout opportunities. We could buy to close our call for 10 cents, and then we could sell to open the September 50 right now for 168. What is this? Negative percent if assigned. This means that the stock has fallen far enough that even though I'm getting another $1.68 in premium, for a total adjusted net credit of the original premium minus the buyback cost plus the new premium of $234, my cost basis is still higher than getting assigned at 50. So I'd have a loss of 2.4%. This is not a viable rollout opportunity. Go to the October 50. It's still at a loss of negative 0.5%. It's not looking good. In fact, we could go to the 55, and that would give me a 5.4% if assigned, but that's again if the stock's above 55, with only a 22.9% probability on the position. So I may have to go out to December in this case to find a positive percent if assigned rolling down in protection as my stock is declining. Thankfully, I'm an Ally as a married put, and it only has a 1.4, 1.7% maximum loss on it. So I'm not too worried about it declining. This stock tends to drop down a little bit to $50.50, 51, and then come back up to that 53 range and go down. It's a great time just to analyze selling calls at that price when it gets up to 53 or 54, and buying them back when they've hit their 80% success rate. Now, the 50 would have given you more downside protection. And to be honest, if we had sold the 50 and the stock had fallen to 5106, I'm still looking good. The return was much lower at only 1% with the in-the-money covered call. But in the next 14 days, I still have a reasonable probability of getting assigned. I'm not worried about managing it right now. What if we just had the stock? And on the 27th, we were bullish on Ally, and we had bought 100 shares at 53.54 with no hedge to start on the position. As we know, the stock's down 248, 250, so we're down 4.6 on just the stock rather than 3.4% from the initial hedge we got for the covered call position. And now that it's fallen, you see that you would have to roll out further in time and down in price for a better hedge. Is there anything I can do with the stock that's now down close to 5%? I'm sorry, 4.6%. Just as we did with the covered call, we can go to Position Actions, we can go to Position Analysis. Well, it's a standard stock breakdown, but we do see that we could sell the October 55 for about 68 cents, and that gives us some reasonable downside protection and premium, but we're down a lot more than that 68 cents. We'd know we'd have to go out further out in time, to try to find a premium to hedge our 248 loss. Or there may be another way. And the other way, of course, now that the stock has fallen, is we may be able to use a stock repair. This is a ratio call spread that can help you get back to break even faster on the position. If, of course, your expectation is the stock is going to recover. So we put in our cost basis, we put in our number of shares, And what this tool tried to do is build credit repairs for us, where we'd maybe be selling 255 strike calls and buying a 50. It's a ratio call spread, but we get a small credit in, and essentially it's nothing naked. In a regular ratio call spread, you'd have something that's naked because you're selling 2 and buying 1. But here we have 100 shares of stock, so the broker sees it as a covered call with a bull call debit spread. Unfortunately, there are no credit spreads that could be found going out to January or December that would give us a credit and would get the position to a repair. And the reason why is because there are some debit repairs that might cost a little bit extra. Remember, our cost was $53.54. Stock's trading at $51.06. Even if I add this extra 64 cents for this December repair, it lowers the break even to $52.09. How is that possible? Even though I'm adding cost basis into the position. The reason why is because of this advantage, buying 150 strike call at 4, selling 2 at $1.68. This is for December expiration. And what this ends up doing is giving me a bull call debit spread at 50 to 55, a 5-point spread, for a debit of 64 cents. Plus that extra premium there of a standard covered call position with my 100 shares of Ally and that call premium. And actually, the debit's a little bit less than what I had mentioned, but that's perfectly fine. But if the stock does move back up in price as we're expecting, this is the bought call. This is gaining in value, as is the stock. So that's that little acceleration there in the profit position, and why the break even drops to 52.09 is because the long call is gaining in our favor as the stock is gaining back premium. And even if we hit the cap here at 55 on December expiration, what would happen? We deliver our 100 shares of stock, get the 5 points back for the full 5-point bull call debit spread at assignment, and we get a 10.7% return. I prefer to use a credit ratio spread, a credit repair if possible, but in the case that it's not and you're slightly neutral to bullish, small 5% loss on the position, the stock repair is a good idea to consider using. So covered calls, Ben, act as a hedge initially when you open a position, but the hedge only exists, to the premium that you initially took in on the position. Anything beyond that premium as it continues down becomes a loss. But of course, you can evaluate the rollout opportunities to see if there's anything that you can roll down to now that the stock's declining to get you enough premium to put you back into break even. But remember, evaluate that percent if assigned return. I don't want to roll down for the sake of rolling down to get more premium as my stock is declining. Because if I roll down to the September 50 strike, and it's great to see things numerically, but when you're evaluating a rollout, you can see the side-by-side picture. I don't want to roll to a position here in a panic where my upside return is negative if Ally bottoms out at 51.50 and the next 10 days starts going back up to 53 and 54. Did I lower my cost basis? Yes. But now if I get assigned at 50, I'm taking a loss on the position. I'm being assigned for a loss. That means I have to pay more to buy this back to try to roll back up. And now I'm just constantly lowering my returns because I rolled too quickly and I rolled for the sake of rolling. Always want to make sure you're rolling for a positive return if assigned with something that matches a new net premium to help your break even in those cases. If you're in just a long stock and the stock starts to fall against you, should you sell a call right then to help repair it? Well, you'll get premium, but remember, the premium you get might be smaller than the loss you've taken on the stock. Your percent if assigned to the upside might be negative. You want to try to avoid that because you can get caught very quickly when the stock starts to rebound, having to pay more now to buy back that in-the-money call.